Welcome back to the Fourth Revolution Quarantine Edition. I'm Daniel LeBeau, and today we're going to be discussing some technical levels I'm looking at, and the markets seem to be following quite well, as well as four stocks that I think are undervalued in these unprecedented conditions. So I'm going to take a look at the S&P 500. I'm using TradingView's trading tool right now. I charted out a Fibonacci retracement level here, and we're looking from February highs to March's lows over here. And we've actually tracked quite well with these levels. As you can see, we've interacted very well with this 61.8% retracement level, which is the golden ratio in which this Fibonacci retracement was derived. We bounced off of it in late April, and again, we bounced off of it earlier this week, coming down to this 50% retracement, which is where we're at today, right around 2,800. And I'm not looking to buy quite yet. I think we're still a little bit overvalued. I don't think we're going to retest our lows, but I think that we have potential to continue to further push down. And I'm looking to buy the stocks I love right around 2650. I think that there's been an enormous amount of monetary and fiscal stimulus, which is going to prop up our market and not let us retest these lows. So look for this 2650 level to buy some of your favorite stocks at a discount. I don't think we're going to fall too much below that, but that is a great opportunity, I think, to get into the equity market. So here's kind of a trend that we've been seeing since the beginning of the year. This is the Nasdaq 100 compared to the S&P 500, which is in red here. And as you can see, we've outperformed the S&P 500 significantly, as in the Nasdaq 100, because of the necessity of a lot of these tech companies. A lot of these tech companies are getting a tailwind from this pandemic, whether it's a social media company like Facebook getting more engagement, a streaming company like Netflix, or even Disney getting more viewership and subscriptions. We've been able to outpace the broader market with these technological advances that are becoming a necessity in this day and age. So I'm going to look at four companies that I think have been underappreciated amid this pandemic. The first one is Alibaba. And I know I've pitched this company a lot before, but I can't understate how much I think this company has as far as potential goes. Any price under 200, I think, is a magnificent buy for Alibaba. Right now, I'm looking to see us test this 200-day moving average, which is the orange line you see in front of you. We bounced off of that in early May here, and I think we're going to do that again. I'm probably looking to buy the stock around 190. But like I said, getting it any price below 200 is a great buy. For the reasons I think Alibaba is a great buy, let me just reiterate, is the fact that Alibaba is not only more profitable, not only produces higher margins than its competitor Amazon, but it also has a larger growth potential as this company controls the e-commerce and digital shopping industry of not only the most populous, but soon to be largest economy in the world. So Alibaba is a buy right now. Disney, this stock has been hammered since the pandemic took hold, as they had to close down one of the biggest profit drivers, the parks. And we haven't really recovered too much from our lows. We're trading around 100 today. I like this stock because of its Disney Plus platform, which is their new direct-to-consumer streaming platform, which is actually a huge competitor to Netflix. It's already had over 50 million subscribers in the first 6 months of its release and continues to gain traction in this stay-at-home environment. But right now, they're starting to open parks. They opened their Shanghai park partially earlier this week and are planning on starting to open their Orlando park in Florida, parts of it at least, on May 20th. And that's in line with Florida's economy reopening schedule. So I see this company as bouncing hard once these parks are scheduled to reopen around the world, and I think that we're going to see a big bounce back. I'm looking to buy the stock any price below 100 if I can get it. Lockheed Martin, this company is a huge government contracted company. It derives about 80% of its top line from government contracts. Actually just locked in a $34 billion contract, the largest in history for its F-37 aircrafts, and this is a locked-in top line. So I think it has some buoyancy and some immunity to the pandemic because of this contract. Some people are worried about the government not having enough money to continue paying Lockheed Martin, but I mean, the federal government can just keep printing money and keep driving this company to new highs. I mean, right now this company is kind of falling in line with the broader market as far as performance goes, but I think we should be seeing a little more buoyancy once investors understand the rationale behind this buy. But I like this stock at pretty much any price around 350 or below. A lot of analysts are giving it a price target of 450 or above. So there's a huge amount of upside potential here. And as you can see, we're hitting our 50% retracement. I might start buying at the 30 or 330 level right here, which is another Fibonacci retracement that I think we may hit sometime in the next month. So Taiwan Semiconductor Manufacturing Company is the final company I'll be discussing today. This company is a significant driver of the fourth revolution. It is the largest manufacturer of chips in the world, with more than 50% of the chips coming from this company. Its capabilities and scale are unmatched. It's one of the only companies that are able to produce the 10 nanometer integrated circuits, and companies like Qualcomm, NVIDIA, even Apple and Microsoft are using this company because it's becoming a necessity. And the U.S. government's actually trying to get TSMC to create a manufacturing plant in the U.S., but they're still in talks with the company. They're not going to make any decisions before weighing all their options. But looking at the stock, I think we're undervalued. This company not only delivers you with a strong over 2% dividend, but its upward potential for capital gains is enormous, as hyperscaling as well as 5G computing drives hardware into a new wave of growth, and TSMC is well positioned to profit off of that. So thanks for watching, guys. Don't forget to like, subscribe, and comment. Today we've got a promo for Zacks, looking at some of our commodity insight. So check that out at zacks.com/promo.